Let's look at the statement of stockholders' equity for American Eagle. Again, it could be called shareholders' equity. This is going to explain what happened to the owner's claims to the company or to the assets of the company during the year. But in this case, the past 3 years. Like the income statement had to report 3 years. Now let's look at the top line here. As of January 31, it had $1,409,031,000 in equity. What that is composed of is the sum of these two, which is the amount they have the owners have contributed to the company in exchange for stock. In other words, the company probably got cash and gave up stock. Retained earnings represents all of the net income kept by the company, meaning it's your net income over the years minus all the dividends over the years. Treasury stock, what this is a contra equity account. It's got a abnormal balance or opposite balance. It has a debit balance. These are all credit balances. This is representing the amount spent to buy back its own stock. Companies will buy back their own stock because they may have promised to sell stock to, say, their executives at a future date, and when they do that, they need to actually buy back their own shares and then give them or sell them to their executives. That's what stock options are. So let's look at what happened during this year. It issued stock, so what probably happened is they debited cash for $39,904,000, and then they credited these stock accounts for the same amount. Repurchase of common stock, what probably happened here is that they debited treasury stock and credited cash, got back their own stock and gave out cash. Reissuance of treasury stock, what's happened here is probably they debited cash, and that's probably money from their executives. And what they are doing here is they are crediting treasury stock, and here what's happening is they didn't get as much as what they had paid for it. So the difference is basically reducing retained earnings beyond the scope of this course, but the general idea is that they reissued or sold their own shares to somebody and got $12,564,000. Net income comes right off the income statement. It increases your retained earnings. Remember, beginning retained earnings plus net income minus dividends equals ending retained earnings, with the exception of some items. Other comprehensive income, that represents the amount they would have earned had they sold certain investments. What they would have gained by selling certain investments. So let's say, for example, American Eagle holds shares of other company stocks. At the end of the accounting period, if the stock price went up, then they have a gain. So what the entry would be is they would debit the investment, that's an asset, for the increase in the price, and they would credit this other comprehensive income. They don't get to credit gains because these are what they call unrealized gains, or it could have been an unrealized loss if the price had fallen. So it's basically a what if number. What if they had sold it? If they had sold it, this is the additional income they would have earned during the period. And then we have dividends, and what we have here is I'm assuming had a bit of a stock dividend. In other words, they gave probably cash, but they also gave shares of stock as a dividend. Now, I want to look at the equity ratio down here. This is the return on equity, and this is very important to shareholders. You're going to take your net income and then divide it by your average shareholders equity. Remember, net income is for an entire year. We don't want to just take our ending shareholders equity balance, because we started the year with this amount, ended this year with that amount. So the net income earned during that year is was using all of these amounts. So by averaging, it just gives you a better measure. Now, as far as how you calculate it, you take, again, your net income plus your beginning shareholders' equity minus your ending shareholders' equity. I said that backwards. This is the ending plus the beginning. Doesn't matter. Divided by 2 to get the average. So on average, they had about $1,300,000 and I don't know, 800,000 bucks, 100 million bucks, excuse me, and divide that into your net income. What you get here is 11% rounded, meaning for every dollar of shareholders' money in the company, American Eagle made them 11 cents. Now, where is that 11 cents? Well, the 11 cents is, they may have paid some of that out in dividends, or will pay them out in dividends, but the other is just the growth of the company. And that leads me to another measurement, and it's market capitalization. You have to remember that shareholders' equity is based on the original cost. Your assets are at historical costs with some exceptions, but mainly cost. The shareholders' equity represents your assets at cost minus your liabilities. But if you think about it, the price of common stock, what you could buy your shares for, is not going to be the same as your cost. So the price will not be the same as, when I say cost, I mean your book value. The books, your assets, liabilities, and shareholders' equity are based on past transactions. The price of of shares of stock is basically going to represent what people think the company is worth based on what they think is going to happen, not what has happened so much. So it's basically the market value is going to be based on the future potential of the company. So if you look at shareholders' equity, this 1,416,851,000, more times than not, you'll find that when you do a market capitalization by taking the price that the stock is selling for times the number of shares outstanding. By the way, the number of shares outstanding is the total shares that were issued. So they had issued a certain number of shares, but then they bought back some. So you take the total shares, and this is not dollars that we're going to use, but the shares that they have issued minus the shares that they've bought back. So you take that number, and a lot of analysts will look for companies that are considered overvalued or undervalued. If this amount is a lot higher than your book value, it may indicate that the price of that company is getting too high, or the stock price is getting too high. And then the other way around is if the price of the stock is close to book value, then it may be a good buy, that the price might be reasonable or undervalued. You have to remember that assets on the balance sheet don't really represent all the assets of a company. There are a lot of things that don't show up under assets, like a company's reputation or the future worth of their employees. In other words, they may be very well-trained employees. There's a lot of things that aren't really reflected on the balance sheet, but have worth to the marketplace, causing this to be greater than your equity on your books.